What's going on, guys? Today, we've got a great episode with Darius Dale. Darius is the founder and CEO of 42 Macro. In this conversation, we talk about global liquidity, what's going on with inflation expectations, how the government may actually be tanking the market in order to actually then build a foundation of strength. And Darius walks through how this should impact your portfolio and various assets. I always enjoyed talking to Darius, and this conversation is no different. Here's my latest conversation with Darius Dale. All right, Darius, I thought a great place to start our conversation today is there's tons of change that's happening. There's lots of chaos, uncertainty. People are trying to figure out where asset price is going, what's going on with the economy. One of the things that I know that you guys do at 42 Macro is you constantly are looking at regime change. And before we get into what the data is telling us, maybe you could define what exactly is regime change?
Yeah, great question, man. Thanks for having me. It's always a pleasure to be here. So I'll start and say that the number one thing that we do for our clients that helps them make money in bull markets and mitigate losses in bear markets is identifying the market regime and helping them position for that either via our KISS or Dr. Mo signals. And so when we talk about market regime, what does that ultimately mean? Well, there are risk on regimes, obviously, and then there's risk off regime. That's kind of the main way you think about regimes. And then in the risk on regimes, you can sort of segment into two kind of regimes. One, there's Goldilocks, where the markets are sort of pricing in risk on with the disinflationary bias in terms of the sector and factor leadership. There's reflation, where markets are pricing risk on with an inflationary bias in terms of sector and factor leadership within asset markets or asset classes. And then in the risk off regimes, we have inflation, where markets are pricing risk off with an inflationary bias in terms of factor leadership, and then deflation, where markets are pricing risk off with the disinflationary bias in terms of factor leadership. So first, it's starting, are we risk on or risk off? That should tell you the kind of asset allocation and portfolio construction you want to have in your portfolio. And then is it inflationary or deflationary? Because that should tell you the kind of factor leadership the bets you need to make, especially if you're an institutional investor.
Okay. Now, what's the data telling us in terms of where we are right now?
Yeah, well, in terms of where we are right now on the market regime side of things, that's reserved for our clients. That's the number one thing we do. So we obviously don't talk about that stuff outside the paywall, but we do talk about what we do talk about outside of our paywall are the things that could cause the market regime to change. And then so we use our grid model as one of the tools in our toolkit that may cause the market regime to change. And one of the things that our grid model has been signaling for months now is that U.S. economic growth is likely to slow and actually slow faster than consensus expects. So that's new. That's different from where we've been for most of the past 2+ years, and as it relates to our resilient U.S. economy theme, where we've been generally expecting growth to accelerate and surprise consensus expectations to the upside. We now have the opposite conditions in place, and that dynamic is likely to persist over the medium term and may cause some headwinds in asset markets from the perspective potentially transitioning us to a risk-off market regime.
Now, you have this great chart where you say, is President Trump doing his best Ronald Reagan impersonation by kitchen sinking the U.S. economy and asset markets? What's that mean?
Yeah, great question, man. So kitchen sinking, I think Elon Musk made that statement popular again when he came in with Twitter with that kitchen sink. And ultimately what it means is you're trying to, sort of cause the maximum amount of pain early so that you can sort of right size the system and then ultimately supply the solutions that get you sort of out of the malaise, right? They're essentially trying to transition from a demand side economy and fiscal policy to a supply side economy and fiscal policy. And that process could potentially be painful, at least in the short term. And this is exactly what we saw when Ronald Reagan became president. If you look at this chart where we show the S&P 500 index, from the 3 months prior to Ronald Reagan's presidency, and then sort of the first kind of couple of years of his presidency, we saw that the S&P 500 actually declined 27%. Basically, in the first, year and a half of his presidency, as he pushed the economy into recession, with some of those kitchen sinking type policies. So that may be what President Trump and Elon Musk are actually attempting to do. So maybe some light version of that, but that's very clearly what it looks like they're attempting to do. If you read the tea leaves coming out of DC, you read the tea leaves coming out of the Treasury Department, and so on and so forth.
The January PCE report seems to suggest that we are seeing slowing growth.
Yeah, 100%. So again, going back to that first chart where we show our projections for growth, we're essentially expecting growth to slow faster than consensus is expecting growth to slow. And I think the January PCE report was the first major hard data report that was supportive of the soft data that we got right over the past few weeks. We've seen a lot of bad soft data, whether it be on the PMI front, the consumer confidence front, small business optimism, all those things declined pretty markedly in recent weeks. And then now we finally actually got a hard data report. So real PCE, which is 70% of the U.S. economy, that slowed from a well above trend pace of north of 4% on a 3-month annualized basis to 2% on a 3-month annualized basis, which is now a below trend level of growth. That slowdown was driven by a sharp slowdown to a well below trend level of growth of 1% for goods consumption. So, we saw a bit of front running of tariffs over the past, several months, and now we're starting to give that back. We had a pretty meaningful slowdown to 2.5% in services consumption from over 3%. And really, I think that the number one thing we have to think about is, okay, why is this slowdown occurring? Why are we now growing at a below trend level of consumer spending as opposed to the above trend level of consumer spending that we've seen over the past last couple of years? And the reality is this is coming because the savings rate is actually increasing. We saw real disposable personal income growth actually accelerate to an above trend level of 3.6%, but we also saw the savings rate tick up over 100 basis points to 4.6%. So consumers are getting nervous, they're getting cautious, and they're pulling back on spending as a result.
Now, is that all because of the uncertainty of policy, or are there other things driving that?
Yeah, well, it's I would say policy uncertainty and how that's contributing to the confidence channel is the main driver. Because again, we saw real disposable personal income growth and nominal disposable personal income growth accelerate to above trend levels in January. And so the fact that we saw consumer spending slow sharply still tells you that this was really being driven by the increase in the savings rate. And so why you just put yourself in the shoes of an American consumer. We're both American consumers. Why would your savings rate go up? Well, suddenly you don't feel as confident about the economy and the labor market and your role within that system as you did. And so in this chart here on slide 4, we show the Baker Bloom and Davis U.S. Economic Policy Uncertainty Index. And essentially outside of, the height of the GFC and the height of the COVID crisis, we have as much policy uncertainty as measured by this particular index as we've essentially had ever. And so in my opinion, that's definitely weighing on growth. And we saw it weigh on growth in Q4 as well. You go back to the Q4 GDP report, business investment on a real basis contracted minus over 2% in Q4. And that may continue as long as we have this elevated policy uncertainty.
You've got this slide that shows that consumer confidence is pulling back. And bullish stock market expectations are coming down as well. I was definitely in the camp of, hey, Trump's good for the stock market. He's going to do everything he can to push it up. Maybe he does end up doing that over the long run, but it does feel like market expectations have shifted here.
Yeah, 100%. And I think I'm so glad you said over the long run, because I think what matters here, and this is what always matters to investors, is the sequence. The sequence is more important than the destination. And so as it relates to the sequence, yes, over a long-term time horizon, the net result of President Trump's economic agenda may, contribute to a boom in the economy and a boom in asset markets, but it may not from this starting point, especially in the context of legislating and implementing a bunch of change from a policy perspective relative to a Biden administration that was also very supportive for the asset markets and very supportive for the top half of the K as it relates to the distributional aspect within consumers and business. But getting back to this chart, in the third panel of this chart, we show consumer confidence for the Conference Board, consumer confidence for high income households. You saw that's declined for the second consecutive month. It's the lowest print we've seen in years in this particular indicator. And then you see the bullish stock market expectations. That's the third consecutive month of decline in that particular sub-index. And it's now starting to fall off a cliff. And so, you think about consumers, the consumption story here in the U.S. economy has been largely driven by the upper income part of the distribution. If you think about the distributional share of consumer spending, the top third of households, spend more than 50%, contribute to more than 50% of total consumer spending, whereas the bottom third only contribute 15% of consumer spending. So we have a very K-shaped economy that, in my opinion, was the reason President Trump was elected. There was a popular mandate to sort of fix those distributional ills, if you will. But at the end of the day, the path that they may take to fix those things likely require some pain, and they may actually be trying to front load all of that pain, much like what we saw with Ronald Reagan and much like what Elon Musk did with Twitter.
On slide 6, you have the negative impact of President Trump's protectionist policies on the North American economy. What are you guys seeing there?
Yeah, so we got the manufacturing PMI data this morning, ISM in the U.S. and then the global PMIs as well over the course of the weekend. And if you look at the top panel where we show the North American economies, you see the ISM manufacturing ticked down to 50.3 on a headline basis, but we actually saw it slow, the fastest month-over-month slowdown in the new orders component since April of 2020, since the lockdown of April in 2020. So new orders are contracting on a delta basis as fast as they have since the COVID crash. And then if you look at Canada and Mexico's manufacturing PMIs, those are slowing sharply as well. And they're now well below 50 at kind of 47.8 apiece. So we're already starting to see the impact of just the uncertainty regarding tariffs and the protectionist policies, cause a contraction in manufacturing activity here in North America. And obviously the implementation of those policies is going to have an incremental negative impact as well. So this is policy uncertainty. I've been saying to our clients over the past few weeks, we're getting clarity on bad policy like tariffs and restricting immigration, but we still don't have clarity on the good policies as it relates to deregulation, tax cuts, the size, the ultimate scope of the DOGE project. We don't have any clarity on the good stuff, but we have clarity on the bad stuff, and it's now really starting to weigh on the data.
Let's talk about some fun stuff, which is the Fed. Are they going to take the 2% inflation target and move it up to 3%, or are they going to leave it at 2%? Today's episode is brought to you by Bitcoin IRA. Are you a crypto investor with a retirement account but don't have any crypto in your retirement account? Listen up, this is for you. Bitcoin IRA is revolutionizing the way Americans save for retirement by helping smart investors diversify their savings with access to over 75 cryptocurrencies. With world-class customer service, military-grade encryption, and a vertically integrated licensed trust company, it's no wonder more than 200,000 Americans trust Bitcoin IRA to secure their financial future. Get started. It is quick and easy. It takes just 3 minutes to open an account. Once you're set up, their team of IRA specialists will reach out to guide you through every step of the process. Whether you're transferring an IRA from a legacy bank, rolling over an old 401k, or starting fresh with a new contribution, the Bitcoin IRA team is here to help you get access to real crypto in your retirement account. And here is the best part. As a Pomp podcast listener, you can earn up to $1,000 in rewards when you add funds to your account before tax day. Search for Bitcoin IRA in the App Store or visit bitcoinira.com/pomp to join 200,000 Americans on their journey to upgrade their retirement. That's bitcoinira.com/pomp to upgrade your retirement today.
Pomp, this is the question of the year and one of the great questions of our time as it relates to where we are in this fourth turning process. What you're seeing on the slide here, slide 7 is our secular inflation model. And what this model is designed to do is, interpolate the normalized change of these major, economic variables that have been academically proven to be correlated or co-integrated with the underlying trend of inflation. We're trying to interpolate the normalized change of those variables in this business cycle onto the underlying trend of core PC inflation to see if there is a structural shift in the equilibrium rate of core PC inflation. And our model suggests that there has been a structural shift in the equilibrium rate of core PC inflation. It used to be somewhere around, the mid twos, sort of mid ones, sort of low, it was 1.6%. If you look at the 2010 to 2019 decade, it was probably closer to 2%. If you look at the latter half of that, our model suggests that the equilibrium inflation, the core PCE inflation rate in the U.S. economy is somewhere between the high 2s and low 3s. And it has every month since we've refreshed this model for our clients in our monthly macro scouting reports since January of 2022. And so ultimately, go back to that first chart where if you look at the bottom right plot, where we show our core PC inflation forecast, we have core PC inflation bottoming here in Q1 and starting to meander higher in Q2. And by Q3, it'll be pretty clear that we're in an uptrend in core PC inflation. If our model is correct, it may not be correct, but our model has been generally more accurate over the past few years than Wall Street consensus. But if our model is correct and we do have a uptrend in core PC inflation, I think what's going to happen is the market narrative around accepting the fact that we're going to get back to 2% inflation, in 2027 or 2028, these made up long-term, forecasts that the Fed keeps throwing out there. I think the market's comfort with that will start to dissipate because the market will say essentially, hey, you're wrong on inflation now here in 2025. Well, I can't trust you on 2027 or 2028. And so ultimately what it's going to do, in my opinion, again, if we're right on the uptrend, it's going to force the Fed to have to acknowledge that the equilibrium core PC inflation rate in this business cycle is higher. And ultimately, if they're going to have a tough choice to make. If it is higher, do you want to just bury your head in the sand and kind of try to pound us back to 2% by running monetary policy way too tight? Or do you just revise the inflation target higher and give yourself policy flexibility to use your balance sheet to take some pressure off of investors from capitalizing the U.S. government? And one final thing I'll say on this is I think they should revise their inflation target higher and acknowledge that we have a higher equilibrium level of core PC inflation, because ultimately what that'll do is it'll address some of these K-shaped distributional ills that we've seen in the economy that have caused so much political chaos in recent years, right? If you think about the marketable treasury market, we've gone from us, the private non-bank sector, me, you, and everybody else that's not part of the government or part of commercial banks or part of foreign central bank reserve managers, us, the rest of us, have had to go from 36% share of the marketable treasury market in December of 2021. Now we have a 56% share. We've gained 2,000 basis points of share in terms of us having to capitalize Uncle Sam over the past few years. And that's obviously causing a crowding out in asset markets. You can see it in terms of, the Russell 2000 has been flat on its back. Basically, any stock that is tethered to the real economy has been flat for years. But every stock that's, tethered to the digital economy, we've seen that kind of K-shaped play out. We've obviously seen the K-shaped dynamics play out with respect to consumer spending and the quality of life here in this country for the lower half of the K. And so ultimately, if we can stop the Uncle Sam from crowding us out from an investment standpoint, that'll trickle down into stopping that, eliminating some of that crowding out that we're seeing from an economic standpoint as well. So I think the Fed needs to use its balance sheet to take some pressure off of us, the private non-bank sector, because if they don't, we're going to have some significant problems in 2025 in asset market terms.
I have for years said that I thought that they were going to increase the inflation target, and people used to say that I was insane. So the fact that you're even suggesting it's possible makes me feel a little bit better that maybe I'm not so crazy.
Yeah, no, you and I have been talking about this for years, man. Absolutely. And look, you and I don't want to toot our own horn, but this is a horn toot, and so close your ears if you need to. You and I have consistently stayed 1 to 2 quarters ahead of the consensus in these discussions, and it's not because I'm smarter than anyone or you're smarter than anyone. It's because we're doing the work. I know your research process. I know how hard you work. I know how much you grind for your clients and for your investors. And we're doing the same thing at 42 Macro. It's not because we're smarter than everyone. It's because we're working harder, and that's the beauty of this country. You can outwork people and have success.
Facts. Explain slides 8 through 10.
Yeah, so slide 8 through 10, real quick. So a lot of everything we just said here in the last 20 minutes or so is designed to help you guys or whoever's listening understand the full distribution of probable outcomes. So, and the reason that's important is because we, in terms of how we help our clients actually make money in financial markets, is we use systematic quantitative signals. I don't say, hey, growth's going to slow, so sell or short stocks or sell or short Bitcoin, or growth's going to accelerate, or liquidity is going to go up, so buy Bitcoin. I say liquidity is going to go up. Therefore, our systematic signals are probably going to make sure that you're long Bitcoin throughout that process. But if my fundamental prediction is wrong, those systematic signals will say, Darius, you're an idiot. It's time to sell Bitcoin, right? And so, if we, what we found is that the results that our clients experience from following the systematic signals are better than the results that our clients experience from our fundamental research. And, as I just said, we've had some of the best fundamental research on global Wall Street for the past since the inception of our firm. So that's what this chart on slide 8 is just comparing how we think about asset allocation and portfolio construction and how those things change over time for investors in their portfolios relative to how most people think about it, which is, I think XYZ is going to happen in the future, and if XYZ doesn't happen, I lose money. Right? That's how most people invest. How we invest and how a lot of the top institutions on global Wall Street invest is we think XYZ is going to happen, and we're fine, allowing our risk management signals, keep us in the proper asset allocation and portfolio construction. But if our fundamental research process is wrong and XYZ doesn't happen, then we have this risk management system come in and actually change our exposures for us, sooner than we otherwise would if we were just relying on fundamental information alone.
Makes sense to me. What do you think about the crypto strategic reserve? Today's episode is brought to you by Gemini. The future is being built today, and the future of currency isn't dollars, euros, pounds, or yen. It's crypto. And Gemini thinks that's a great thing. Because a future where money is decentralized, inclusive, and globally accessible, that's a future that we are anxious to be a part of. Gemini teamed up with futurists, technologists, and designers like award-winning artist Matt Griffin, known for his illustrations for Dune, to craft a vision of the future with crypto at its core. The creative theme, Go Where Dollars Won't, emphasizes exploration, growth, and the crypto market's limitless potential. Whether it's going on that Martian safari to capture an unforgettable photo of a herd of woolly mammoths grazing the red planet, or using Bitcoin to pay for your lift pass to go strata skiing down the mountain peak of a breathtaking comet. Whatever adventures we'll be living, one thing is for sure. In a future this fantastic, the limits of traditional currency simply cannot keep up. Financial innovation will usher in this new frontier, and so go where dollars won't with Gemini. Go check them out at gemini.com/go where dollars won't. Again, go check it out at gemini.com/go where dollars won't.
Yeah. So my initial thoughts are the reason, just compare us to countries that actually have sovereign wealth funds. Those countries have large current account surpluses that, contribute to, essentially a growing stock of reserves and savings at the country level, right? If you think about, your current account is your spread between your gross savings and your gross investment in your economy. And so if you have savings, i.e. you have a trade surplus, et cetera, and you have a fiscal surplus, or the net of your trade surplus is greater than your fiscal deficit, then you're growing your savings, and you have savings to actually invest in asset markets. We don't have that dynamic. We have a 7% budget deficit to GDP, right? And so my perspective is, where are we going to get the money to actually finance a strategic crypto reserve, right? Like, are we going to have to issue debt to buy, to buy crypto assets just so that we can sell the crypto assets later to pay down more debt? I mean, that sounds about as dumb as anything as I've ever heard. You were suggesting that in our pre-production that they could revalue the gold and rotate that into crypto. That's a smart strategy. But again, I still think that if your goal as a crypto investor, if you're listening to these types of headlines, you have to understand that we don't have money as a country to acquire these assets. So we have to issue debt on top of any sort of gold revaluation. Do you have any thoughts on this? Because I find it to be kind of preposterous, but I hope I'm not too crazy.
I don't think that we should put anything other than Bitcoin in the strategic reserve. And that's coming from someone who is going to financially benefit from the fact that they will put other things in there. That is good for me. But I don't think that we should do that. I instead think that it should be Bitcoin only or nothing. And, it's this weird dynamic. Like, one, those other assets are not strategic. Two, to your point, where does the money come from is pretty important. And then three, and maybe the part that people don't really think as much about is the precedent. If we set a precedent for us to speculate, let's go buy Tesla stock. Let's buy GameStop. Let's buy Palantir, right? Let's buy Berkshire Hathaway. Yeah. And if we're going to do that, let's go put LP interest from Citadel and Millennium, and hey, Rentec, why don't you guys go in there? And let's go get our favorite private credit fund. And then Apollo wants to be, you know what I mean? It's just like, where do you stop? Might as well just give the balance sheet capital to Jim Cramer. Let him pick individual stocks, right?
Yeah. So you're right. Who's in charge of this stuff, right? Like, are we assuming that every Treasury Secretary has the investing acumen of Scott Bessent? Absolutely not. I mean, I don't want Janet Yellen managing a strategic anything reserve. Right?
Yeah. And my guess is that they're not going to do active management, but the point just being like, look, we have a lot of strategic reserves of very different things. Most people know that we have a strategic oil reserve. They know that we've got a strategic gold, kind of a reserve. They know that we have a strategic stockpile of medical supplies that obviously when COVID happened, right? But we also have helium and rare earth metals. We even have, a lot of people don't know this, we have a strategic reserve of cheese. Senator Lummis from Wyoming, she recently told me that. That was a great one. So look, we got weird stuff, but it's strategic. There's a reason, right? We have a strategic reserve of, I think it's home heating oil for northeastern homes.
Yeah, they do.
Anything happens, right? We can go ahead and actually make sure the homes are heated. There's reasons for this stuff. Bitcoin is digital gold. If you have the analog version, you should have the digital version.
Agreed.
There's no precedent for these other things. And so again, What I think is not going to matter. No one's going to listen to me.
They should. Why wouldn't they listen to you?
Look, they're going to.
You and I should just run for president in like 10, 20 years. I'll be your VP, and then you be my VP.
There's a game of lobbying going on that is unlike anything that the world has ever seen, because crypto is Wall Street magnified. And so now what you have is a very high stakes game of who gets included in the reserve. And you're getting a bunch of crypto projects that are going to do everything they possibly can to make sure they're included. And as we've seen, crypto projects, they got a lot of money. And, frankly, they're willing to do whatever it takes.
Well, here, I still have a question. And I agree with everything you just said. I still have a question, because you actually, the one thing I disagree with is you said they're probably going to not have an active management approach. Unless they have the portfolio mirror the global investor portfolio, they're making active decisions, right? Like just by adding these tokens and not other tokens, you made an active choice. You will have to make an active choice every time you sell something in the future to either pay down debt or to finance some other initiative of the government. And so these are all active choices. How do you determine what the weights are? Like, what if Solana doubles or triples in value relative to Bitcoin? Now you have this massive Solana position. Do you need to rebalance that? These are all active choices and choices that institutional clients have to make on a daily basis. And so again, it goes back to, where's the money coming from? Who's managing the money? What assets are in there? And how does this ultimately benefit the American public? Because right now I feel like it's really just benefiting Donald Trump from a political standpoint. He knows how popular this type of stuff is with a certain cohort of voters. And so just give them what they want. Tell them they're going to give them their future Bitcoin reserve. And a lot of people aren't going to think critically about what are the ultimate implications about the stuff that you and I are talking about. And so I just want to make sure that people are thinking critically about these things as American citizens.
The last thing I'll say is I don't think most people in the crypto community actually agree with this. I think they think it should be Bitcoin only or nothing at all.
Good.
So we'll see.
Good.
Where can we send people to find out more about 42 Macro?
Well, 42macro.com. Come check us out. We got a little something for everything. We got clients all across global Wall Street in the investment management space. We have retail clients all over the world, 80 different countries. We're doing a good job for our clients, and we're going to expect to continue doing a good job. So thanks for checking us out.
Legend. All right. Thank you very much. We'll do it again.
Thank you, brother.